Good morning and welcome to this Spence and Partners webinar for employers in the LGPS. Why are we talking about this now? Well, in England and Wales, LGPS schemes have a valuation every 3 years. That valuation date is the 31st of March 2025, and results are just starting to come out now for employers. So either out or coming out imminently. So what are those results going to look like? What sort of contribution levels might there be, and what can you do about it as an employer? I'm Alistair Russell-Smith, and I head up the charity and not-for-profit sector pensions practice at Spence and Partners, and I'm delighted to be joined this morning by my colleague Sean Campbell as well, and also you'll see on screen Becca Lavender, who is in the background to help if we have any technical issues. So in terms of what we'll be covering, you can see on the right-hand side of this screen. So Sean's going to start with a recap of the 2022 valuation position in England and Wales, explain what's happened in financial markets since then, and therefore what we can expect in terms of valuation results for 2025, and also the valuation timeline. I will then come in and talk about a case study for one of our clients that's received their results, and finish with some top tips for employers on what you should be thinking about with the valuations. We've got probably about 20 or 25 minutes of content that Sean and myself will go through this morning. So we've got time for questions. If you've got a question, feel free to put it into the Q&A box. Hopefully you can see that at the top or the bottom of your screen. If it's not immediately there, have a look at the more icon and it may appear there. You can ask a question in there, and fear not, that question just goes to Sean and myself. So ask away, ask any questions you like. We'll try and deal with those as we go at the end, or failing that, we can pick up questions you might have afterwards. And also, you will also receive a recording of this webinar and the slides afterwards, so you can get that to look at afterwards too, if that is helpful. Right, so let's get going. Sean, let's start with a recap of the 22 valuation position.
Yeah, okay, so thanks, Alistair. So, yeah, looking back to 2022 valuations, overall funding levels had generally improved compared to the 2019 valuations. So, on the screen, you can see two charts published by the Government Actuaries Department, which gives us a closer look at how these funding levels changed between 2019 and 2022. So, starting with the chart on the left-hand side, this shows the number of schemes within each funding level band. So, the kind of greeny blue lines represent 2019, while the purple lines represent 2022. So what really stands out here is that there's a significant number of schemes moved up into the top two bandings in 2022. Those correspond to schemes that were over 100% funded. So at the other end of the spectrum, back in 2019, there was only one fund below 60% funded, but by 2022, there were none. So overall, we can see a clear trend of improving funding levels across the board. So if you look at the pink box at the bottom of the chart, you'll see that in aggregate, the funding level as at 31 March 2022 was 106%. So it was really in a strong position. Now turning to the chart on the right-hand side, this one shows how funding levels changed between 2019 and 2022 relative to the size of each scheme's liabilities. So the darker the orange dot, the greater the increase in funding level. So as you can see from the scale beneath the graph, there was quite a range in these changes. So at the upper end, schemes saw improvements of around 30%, while at the lower end, a small number experienced a reduction of about 2.6%. Now, what has happened since 2022? What you can see on screen now shows how broad market indices have moved from 31 March 22 right through until the end of September 25. Let's start by looking at the bottom two lines on the chart, so the kind of green and blue lines, up to the first dotted marker at 31 March 2025. These lines represent index-linked bonds and corporate bonds respectively. So over this period, returns for these classes have been challenging, so around -30% for corporate bonds and closer to -50% for index-linked bonds. Now, broadly speaking, cessation liabilities tend to move in line with the green line on the chart. The rise in interest rates we've seen over the last few years have pushed down the value of both index-linked and corporate bonds. So although it's not a direct link, there's a correlation between the ongoing scheme liabilities and the blue line. So using this as a proxy, we would broadly expect to see a reduction in the overall scheme liabilities from 2022 to 2025. If a scheme had invested part of its assets in what's known as matching assets, these are designed to hedge liability risk. Then, when liabilities fall in value, these matching assets would also reduce in value. And conversely, if bond markets had risen, those same assets would have increased in value. Now, if we shift our attention to the top three lines, so the pink, purple, and navy blue, these represent growth assets such as UK and global equities. These asset classes have performed particularly well, delivering returns of around 20% since March 2022. So any scheme holding a reasonable proportion of growth assets are likely to have seen a meaningful increase in the value of their assets over this period. So overall, the market movements up to 31 March 2025 have been very favourable for pension schemes, and we would expect to see this translate through to further increases in funding levels in 2025. Finally, it's worth noting that the chart also shows a further improvement in market conditions after March 25, particularly among the growth assets. These continued to perform strongly after a brief dip around the time President Trump announced the new tariffs in early April. So it's an important point to consider how much of this positive post-valuation experience has been factored into the latest valuation results. If it has been taken into account, it could potentially reduce the contributions required from you going forward. Now, turning to the 2025 valuation itself, on screen we've set out a broad timeline, and as you can see, we're now moving into the key period for employer engagement with your funds. By this stage, much of the kind of initial groundwork will already have been completed by the fund and their actuaries, things like data updates, initial calculations, and early results. And now we're starting to see some of those valuation results being shared with employers. This is really your window of opportunity to engage with your fund, to review the results, ask questions, and where appropriate, negotiate for a favourable outcome. Most funds will either be running or will shortly be running a consultation on the funding strategy statement. This is an important chance to provide feedback and influence how the fund's approach aligns with your organisation's circumstances. So, as we touched on in the previous section, there may still be scope to push for a reduction in contribution rates, particularly given the continued strong investment performance we've seen since the valuation date. So then once the consultation period closes, the valuation results and contribution rates will be finalised with the new contribution rates taking effect from 1 April 2026. So then finally from me, before I hand back to Alistair, so as we touched on already, initial indications are that the 31 March 25 valuation results are going to show some quite significant improvement in funding levels. So Hymans Robertson are an actuary to a number of the LGPS funds, and their early communications are signposting an increase in funding level for all of their funds. So they're typically expecting increases to be in the region of around 25%, but as you can see, some are improving as much as 45%. So one point to note here. Although funding levels are expected to see a significant improvement, this doesn't necessarily mean contributions will also see a significant reduction. There's a concern that the reduction in contributions may only be a modest one, even when employers are in large surplus position. So this just gives another reason to engage with your fund early, be proactive in the process to ensure your voice is heard and your contributions are aligned with your goals. So that's a brief recap of the 2022 valuations, how things have changed since then, and an early indication of the 2025 valuation results. So I'll pass back to Alistair now to run through a recent case study we've worked on and some top tips for you as an employer.
Great, thanks, Sean. So yeah, like Sean said, funding positions have improved, but that's not always translating through to very big reductions in contributions. So we thought it'd be helpful to share results we've seen for one of our clients. So this is a charity that participates in one of the funds. It's a admitted body, and it's got a closed group of employees in the pension scheme. So probably expecting to keep participating in the fund for about 15 years. So you can see, looking at the valuation results at the top of the slide here, that there was that improvement in funding position on an ongoing basis. So the funding level improved from 122% in 2022 to 150% now. So that puts up from 4 million to 7 million. So that improvement in funding level, much like Sean was explaining earlier. Also well funded on a cessation basis. So in the event you stop participating in an LGPS fund, there is a cessation valuation carried out, and that is carried out on a more prudent basis than the ongoing basis. And actually, this fund uses what's called a cessation corridor, which you can see in the table on the right-hand side. So they do two calculations of the liabilities to give a low end and a high end of that corridor. So in this example, the low end is liabilities of 16 million. So if your assets were below 16 million, so if there's 21 million here were, for example, 15 million, you would have to pay an exit debt. In contrast, if your assets were above the high end of the corridor, so above 19 million, which they clearly are in this example, you are in surplus on that cessation basis and potentially getting an exit credit of 2 million in this example. And if you're between the low end and the high end in the corridor, you exit without having to pay an exit debt, but you don't get back an exit credit. So the reason for sort of saying all of that really is that you can see the fund is also very well funded on that cessation basis and above the high end of that corridor. So what has this meant for this scheme in terms of, or this employer in terms of contributions? You can see that on the bottom of this slide. So the contributions into LGPS funds are split into what are called primary contributions and secondary contributions. So the primary contributions are the cost of future pensionable service for your active members. And then the secondary contributions are payable to fund a deficit if there's a deficit, or in some cases, if there's a surplus, you can actually have a negative secondary contribution, which is where the surplus is being used to fund some of that future pensionable service. So in this example, the employer was paying 33% off the back of the last valuation. And the good news is that has come down. It's come down quite a lot to 20.3%. So a reasonably big fall in that primary contribution rate. In terms of what we've seen with some other clients, we haven't tended to see reductions of much more than that. And indeed, if you're paying a primary rate that might be closer to what the local authorities are paying, perhaps closer to the sort of 25% level, you'd probably be seeing a smaller reduction in the primary rate than this employer has seen. But the two things that I guess this employer is a bit agitated about is it relates to, firstly, despite being so well funded and with this very large surplus, that surplus is not being recognised in the contribution calculation at all. So that secondary contribution rate is nil. There's not a negative item there. That surplus is not being used to fund future accrual at all. Still having to pay 20%. And then secondly, when you just look at that in pound terms on the right-hand side of the table here, that 20% only equates to £34,000 a year of employer contributions, which in the context of a surplus that's somewhere between 2 million and 7 million is obviously very small. So whilst there's been a reduction in the contributions, this client's I guess a bit agitated that the reduction wasn't bigger, and also is concerned that it's going to pay those contributions in and potentially not be able to get them back in the future. So interesting case study here, and that then leads on to our top tips for employers. So top tip one is understand the exit credit policy of your fund. I just touched on that in the case study. But when an employer ceases to participate in LGPS, a cessation valuation is carried out. So in this example, on the left-hand side there, you can see that cessation valuation, simple example, assets of 10 million, liabilities on a cessation basis of 7 million, a surplus of 3 million. In that scenario, the fund has a discretion on whether or not to pay that exit credit back to the employer. So an important thing for employers to understand for the valuation process is, will the fund exercise that discretion to pay it an exit credit? And as an employer, you might be a bit more relaxed about paying what you feel is too high a level of contributions if you know you might get that, or you'll get those contributions back on cessation via an exit credit. In contrast, if you don't have confidence you'll get that exit credit payment back, you're probably going to want to take more action now to try and ensure you're not overpaying contributions in the first place. So what are we seeing in terms of exit credits and how those are operated by funds? It does vary. But typically, if you are a charity, you on risk whilst you've been participating in the fund, you've had to pay very large increases in contributions historically when LGPS funding wasn't as strong. You're well positioned to get that exit credit back. You've been on risk during your participation, and therefore it's appropriate that you share in the upside risk that's crystallized on your exit. In contrast, if you are not on risk during that participation, so the classic example would be if you're an outsourcer with a pass-through arrangement where you're just paying a fixed contribution, you're not going to get an exit credit payment back because you haven't been on risk during participating. And then there's a big area in the middle, the grey area, where you may or may not get that exit credit. And the sort of classic example there is if you participate in the fund with a guarantor supporting your participation, so a local authority, for example. In that scenario, you're sort of on risk. You've been paying the contributions, and you've probably had to pay higher contributions if costs have gone up, but you're not fully on risk because of that guarantor. So that's a bit of a grey, nuanced area, and we've seen funds operate in different ways in relation to that. Certainly, some guarantees can be relatively weak from an employer perspective. They only cover sort of insolvency of the employer. And in that case, there is an argument that you have been on risk, you've been funding all the ongoing contributions, they've gone on, and therefore you should benefit from the upside. So yeah, understanding this is really important because it drives your view on what level of contributions is a reasonable amount to pay now. And there are some second order points here as well. So items 2 and 3 on the slide here. So even if you're confident that the fund will pay an exit credit, will that be all of the surplus, or will the fund keep some of the surplus? So they do sometimes keep some of the surplus for things like future administration costs, or they may take the view that some of the surplus emerges from employer contributions, but some of the surplus comes from elsewhere. And also, what is the cessation basis? Some funds are hardening cessation bases, putting that funding target up, and therefore, whilst you might get a surplus or exit credit payment back, it could be much smaller than you'd previously thought because that cessation basis has hardened. So understand all of that, really, really important for how you approach the valuation. Second top tip is to check the time horizon and the investment strategy that is being used in your fund. So thinking back to that case study I talked about, the reason that those contributions were being set at that level, despite there being a surplus now, a very material surplus, is quite a few funds are setting contributions whereby they say, okay, we need so many, we need a level of contributions now that gives us a strong chance of still being fully funded in that case study example in 15 years time, in a particular time horizon. And so if you have a well-funded scheme that's in surplus now, the longer that time horizon, the more risk that surplus disappears in the future, and therefore the need to pay contributions now to mitigate that risk. So what we're looking at on the screen here is a projection of a funding level So you can see on the left-hand side that it's in surplus today. The funding position is above 100%. But as we go out through time, the range of those future funding outcomes is uncertain, and you get this funnel projection. So you can see here 90% of outcomes are included within this funnel. Top 75% of those are the blue ones, and the bottom 25% are the poorer outcomes. And so, as example, if a fund is, for example, saying, okay, we want a 90% chance, which is the gap between the light red and darker red, if you can see that on screen, that is the 10th percentile. So if you say you want a 90% chance of being fully funded in X years' time, you're basically saying, okay, we want our funding level on that 10th percentile to be above 100% here. So you can see that as the time horizon goes out, that line dips below 100%. So you're not hitting that, and therefore you have to pay contributions. In contrast, if the time horizon is shorter, there's less time for things to go wrong, and you therefore don't need to pay contributions. So important to understand what time horizon is being used by your fund, and also to form your own view on whether or not that's appropriate. You will know far more about those employees that are in the fund and when they might be leaving or retiring or any other action you might be taking to shorten that time horizon. So form a view on that and engage with the fund on the time horizon if you're in this situation where you're being asked to pay contributions despite being very well funded. And there's a similar point in relation to the investment strategy. So the other key driver on the width of this funnel is the investment strategy. As you take more investment risk, there's a broader range of outcomes. Now, if we think about most LGPS funds, most employers in LGPS funds are local authorities. They're open to new hires. They have long time horizons. It makes sense that they invest for the long term and take quite a lot of investment risk. But if you are a smaller employer with a closed group of employees in the fund, you're on a time scale to eventual cessation, then really that investment strategy may not be, and you think about how well funded you are at the moment, that investment strategy that's being used by the broad fund may not be appropriate for your own circumstances. So understand what the investment strategy is, and some funds will let you adopt a different investment strategy, and in particular lower risk strategies that narrow this funnel of outcomes and reduce the risk of the current level of surplus being eroded in the future by adverse market movements. So engage with the fund on that, and if you can change that investment strategy, you reduce the width of this funnel, and you therefore remove the need or reduce the need for cash contributions from yourself. And then the last top tip is to consider exiting the funds. The time horizon, the fund will take account of your time horizon, but ultimately it's their decision on where they set that time horizon. Likewise, some funds may enable you to change investment strategy, but not all. The one sort of lever you do have control over as an employer is exiting the fund yourself. So if you do that, you are clearly shortening that time horizon, you're crystallizing the current level of surplus and potentially accessing that exit credit. If you do that, the key thing is to move the affected employees from LGPS to another pension arrangement, which we'll come on to on the right-hand side of the slide in a second. But in terms of the process and the steps to exit, we've just summarized on the left-hand side there. So we typically see employers starting with a feasibility assessment. So understanding things like what is the funding position? How well funded are we? Is there a surplus on an exit basis? What's that exit credit policy of the funds? What are the contractual position in relation to these employees? So is it hard-coded in contracts of employment that they can be in LGPS? Are there commercial agreements that require them to be in LGPS? And also develop that replacement pension proposal that I will come on to. So do that feasibility assessment and make a go, no-go decision. Then start to engage with the fund and other stakeholders. So engaging with the fund in particular to understand exit credit policies. Other stakeholders, the classic is if you've got a guarantor, understanding the views of the guarantor on your proposal. then finalise the replacement pension proposal, and then typically open a consultation with the affected employees, run that, listen to their feedback, potentially refine the offer, and then move after that consultation into making final decisions. And if that final decision is to move employees out and exit, then go ahead and implement that exit. So yeah, end to end, that process typically takes 4 to 6 months in our experience. And then just coming on to that replacement pension on the right-hand side of the screen here. So if we think about the local government pension scheme, employees currently accrue a career average pension of 1/49th of their salary per year of service, and they pay, it varies on salary levels, but they pay about 6% of salary to do that. Now, the route that most employers have historically taken when exiting LGPS is to go down the left-hand limb of this graphic here and offer DC and probably salary sacrifice as well. Why are they doing that? Well, primarily to get equity for across the workforce for pension provision. So you may well have other employees on DC, and also from a cost and risk perspective for the employer, DC manages that and removes your exposure to defined benefit cost and risk. So it's a well-trodden path, and we still see a lot of employers doing it. It's typically the most common way to do it for the reasons I've just explained. But one thing that we're seeing a few employers thinking about now, and particularly employers where they're concerned about the employee relations issue of moving employees out of a generous defined benefit pension, is to actually offer another defined benefit pension as that replacement pension. And one thing in particular is that if a typical defined benefit pension is historically has been a 60th accrual rate, so a less generous accrual rate than the 49ths in LGPS at the moment. But if you offer 60ths with no employee contribution, from a value perspective for the employees, that's pretty much the same as a more generous 49th pension that they're paying 6% for. So if employee relations is a real concern and you're worried about moving from DB to DC, that doesn't necessarily mean you can't do an exit. You could still look at putting employees into DB instead. And this is particularly kind of good fit for those employers that might already be in other DB arrangements. So thinking of higher education in USS, housing associations in various multi-employer sector pension schemes there. But even if you don't have those schemes, there are commercial DB master trusts out there that can provide a DB pension like this relatively cost effectively. So an interesting development we're seeing now that is worth thinking about. So yeah, moving on to just sort of next steps before we come on to any questions, although I am conscious of time. To summarize what we've really talked about. So yeah, firstly, engage with your fund to understand when your results will be available. They may have already come out or they may be coming out imminently, but understand when that's going to be. If you haven't got your results yet, you can still do some stuff ahead of getting those results. So two to four on this list here. So look at the exit credit policy. It's in the funding strategy statement. Understand how it applies to your organization. Form your own view on what an appropriate time horizon might be for participating in LGPS, and understand what the investment strategy is that's going on at the moment. That's disclosed in the FRS accounting numbers, so very easy to see. And then when those valuation results come through, review those in the context of the exit credit policies that we've talked about and the time horizon investment strategy. Look at the contributions. And if you're concerned that the contributions seem too high, or you're concerned that you might not get them back on an eventual cessation, engage with the fund to see if anything can be done about that. We talked about the time horizon as being one lever that you can look at. The investment strategy, potentially another lever you can look at if the fund permits different investment strategies. But failing that, and assuming you're an employer that can exit LGPS, so an admitted body rather than a scheduled body, consider exiting now so that you can actually access those current surplus levels. Good. That was the presentation. I am conscious of time, and we've gone on a little bit longer than we were planning to. Let's just check and take a couple of questions quickly. Sean, there's one question there on exit credits. Are you seeing funds paying exit credits typically? What's your experience?
Yeah, so I think you kind of touched on this after, but it very much varies from fund to fund, depending on whether or not they're going to pay it. And as you kind of mentioned, with exit credits, it's all dependent on whether or not the employer has been on risk whilst they've been participating in the fund. So one kind of case that we've seen, or we've seen it a couple of times now, is even which you touched on, that kind of grey area. So even when there's a guarantee being in place and the guarantee has been quite weak, we actually still have seen an employer receive the exit credit payment. And we've also seen examples where the funding strategy statements maybe haven't been the clearest in their treatment of exits and exit credits. So, and whether or not they're actually going to be paid, but funds have, and again, in those cases, continued to pay out. So, one other thing that's probably worth noting on exit credits as well is it's worth employers putting a representation forward. When that representation is
Mm.
made, it has to be considered by the fund. So we've had a few cases where we've helped employer pull together a kind of strong business case to help getting them that exit credit payment as well.
Yes. Okay. Thank you, Sean. I think we'll conscious of time, so we'll leave the other questions. We can come back to those separately. So thanks everyone for joining this morning. Hope that was useful, and obviously do get in touch with Sean or myself if you'd like to discuss any of those points in more detail. Thank you.